Well, hello, hello, hello. Welcome to anyone watching and or who tunes into this later. Um, I hope you're doing great. I hope you had a wonderful Thanksgiving. That's what week it was for us last week. Depending on when you tune into this, I guess it could be another holiday or no holiday. So anyway, just wanted to come and share some information. Again, Josh Thomas. I'm a mortgage loan officer in the state of Utah. Have been here for 22 years in this role, and I've long loved this job because it shows there's just a lot of what am I trying to say? There's a lot of option or perspective that you gain by looking at. So here's a reality. Um, in the United States, at least in Utah, it doesn't seem like a lot of people are really open with their finances. We don't really tell our friends and our family how we're really doing financially. Um, and I think that a lot of us live under some false pretenses as a result. But as a mortgage guy, I not only get to find out what people really make and what they're really doing, frankly, sometimes they don't even know what they're really making or doing. The banks look at things a lot more detailed, and so we have to dig in really deep. We look at pay stubs, we look at average year-to-date income, we compare it to last year's income, and there's just a lot of perspective that's really, really valuable. So this job is really great for that. Why that matters to you is because I'm here sharing it. I'm not going to be sharing anybody's private information, but I am going to share some of that perspective and that wisdom that you gain from that. That's probably the leading reason I wanted to do this podcast or broadcast or whatever you want to call this. But so for those tuning in, I hope you find it useful, and thank you for spending your time with us and allowing me to be a part of your life. So yeah, without too much further ado, I'll go ahead and just jump in by clarifying that some people are really transparent, and I have some friends who are really transparent about what they make, and maybe it's partially because they have used me in the past, and so they're just really open. But they seem like they're really open with everyone. But a lot of people, they're uncomfortable being that open, and I don't know. I don't know if that's a good thing or a bad thing. I can see pros and cons to it, but I don't think that the majority of people are out running around being deceptive. I just think honestly, a lot of people, they probably embellish a little bit because they're a little embarrassed or whatever. But also, a lot of people just don't know the exact details. It happens fairly regularly that I'll be looking at a pay stub with somebody and I'll ask them, how much, by trying to figure out how much money they make. And I'll ask them the question like, why this or this, or what is this income here that I see? And I'll be really honest, they often don't know. Um, Sometimes employers have shorted them and they didn't even realize it. Sometimes they've gotten extra money and they don't realize it. And so both of those scenarios will happen. So I think a lot of people just don't pay as much attention to their pay stubs and tax returns maybe as they should. So having said all that, there's your first piece of wisdom you might consider is pay more attention. And if you want me to look at something in your story just so that you can understand it better, give me a holler, message me, and let's connect. So okay, I wanted to. I'm going to go through a little bit of. I think I'm going to dive into mainly just one scenario, and then I may give a little bit of a history lesson. Um, and so the scenario has to do with rentals. Um, I've owned rentals now myself for I think it's 8 years, 9 years, 9 years. Had as many as 14 doors. I've consolidated those down presently. I'm down to around seven. I've self-managed all of those until I decided that I was done self-managing probably 4 years ago. And I've been slowly moving more of that to a property manager. So I'm going to talk about that a little bit. I feel like there's a lot of value to that for people who don't have it, don't know it. Um, Before I get too far into that, I thought I would, if I continue after the rental, it depends on how much time this takes. But I may end up getting into a little bit of history. So the Federal Reserve is something that a lot of people don't really understand. The pandemic and the Great Recession, two more things a lot of people don't really understand. Um, like they understand that they were there, but they don't necessarily understand the Federal Reserve's role and all of that. What caused the Great Recession is another one that a lot of people really struggle with. And so I may kind of walk through all of that. I feel like there's a ton of perspective, valuable perspective that each of us can have from that. And so, yeah, I may get to that. We'll see. If not, maybe next week. But let's start with the rental stuff. So when somebody calls me up with a rental question and they haven't already been doing it, or even when they have been doing it already, I tend to spend a lot of focus and time on whether or not they should. And what I mean by that is with, I'm going to adjust my seat just a little bit here. So what I mean by that is, should they buy a rental? So when you buy a rental, the mortgage industry, so remember there's 5 agencies: Fannie Mae, Freddie Mac, FHA, VA, and USDA. And those 5 agencies are responsible for 95% of all the loans done in the United States. Those 5 agencies, and honestly, most of the non-QM, so the rest of the industry that's not these 5 agencies, we call it non-QM. QM stands for qualified mortgage. Non-QM is literally a federal definition, meaning that if you have, what am I trying to say? If you look up federal guidelines, federal rules, you're going to find that they're defined as a qualified mortgage and a non-qualified mortgage. And so all 5 of those agencies currently fit under the qualified mortgage rules. But anyway, those agencies and a lot of the non-QM stuff is actually what they do is they look at whatever incoming rent we might receive. They only count 75% of it, unless we have tax returns showing that we actually keep more of it than that. So what I'm saying is, if you are paying $2,000 a month on your mortgage and you're collecting $2,000 a month, the banks are only going to want to, or the agencies, I should say, are only going to want to count 75% of that $2,000 rent that you're receiving, which is $1,500. And so on paper, it's going to look like, since you're paying $2,000 and you're only receiving $1,500, right? It's going to look like this rental is a $500 liability. And so that's the cash flow number that I look at. Now, most people, most landlords that I talk with, most of them are saying that they're kind of focusing on, hey, if I'm receiving $2,000 and I'm paying $2,000, that's a break even. If I'm receiving $2,001 and I'm paying $2,000, I'm making $1 a month. And that's how most of them look at it, is they're cash flowing $1. But I've personally found it valuable to actually follow the agency's rules. And so when I calculate my own cash flow, I tend to follow the 75% rule. I even have tax returns at this point that shows the activity, and I still just default to the 75% rule because I feel like it's really effective. It's really good for planning purposes. And so let me kind of walk down that path for a minute. So obviously the ideal is that you're making money every month. Yeah. If you're collecting, what's some rent actually? Let's see, 2001 divided by 75%. So if you were collecting $2,668 a month and your monthly payment was $2,000, then you would actually be making money on paper, not just that initial cash flow that most people look at. And in that scenario, Fannie Mae, Freddie Mac, FHA, all of them would acknowledge that you're actually making money, and that would be an income for you. And whether you're purchasing a property, whether you're refinancing a property, that tends to be how they look at it, with the exception of if you've owned it for 2 years and you have tax returns, then we'll look at the tax returns, and that's how we end up calculating cash flow. So why did I bring this up? So I was here in 2005 and 6 and 7. I was doing this job, talking to people, helping them buy homes, helping them refinance. And if you don't know, 2008, the market crashed in a major way. 2000, see, that's the history stuff I would love to get into, because the perspective that you gain from it's intense. But I was here, and it actually began in 2007. I remember being in the airport in February of 2007 and looking up at the TV, and they were talking about one of the companies that I worked with. Actually, I think I just funded a loan with them, and it said that they had filed bankruptcy. And I was like, that's interesting. And the reason it caught my attention is because for the previous 2 or 3 years, I kept thinking to myself, each time I would close one of these loans that didn't make any sense, like somebody who had a bankruptcy yesterday and had 0 down and had a 500 credit score, I could still give them 100% financing on a house. I could give them 100% financing on a rental property on a fourplex. It was crazy what we could lend, and so it's no wonder there was a lot of business going on. But there's also no wonder that a lot of people lost their homes because they weren't mentally and emotionally ready to own. Any case, not to digress too far, but I was there in that era. When I heard that company was going out of business, it was no shock to me, but it alarmed me because I always thought it made no sense. And then when I saw them actually do it, I was like, huh, I wonder what this means for the rest of the market. And sure enough, over that year, 2007, a few more kind of went out of business. And then it was 2008 where it really hit the fan, especially in July. And I'm not going to go down that road just yet, but just in the rental market, what I was here when I watched all these people that had bought a year before, 2 years, 3 years before, and were flipping their rentals, making money hand over fist. I was there when they started losing those rentals, started walking away from those rentals. And honestly, it wasn't just a clean, right? These people were going through a really bad experience. I was there to see some of them end up getting divorced. A lot of them lost their own homes because they just, again, they weren't ready. They didn't have the financial disciplines in place, and it was a terrible foundation they'd built on. So when somebody comes in the door and says, "Hey, I want to buy a rental," what I don't want to see is that person become one of them, right? And I've kind of spent some time and talked with a bunch of my colleagues and stuff, and it really seems to boil down to just two things. If people would do two things differently in 2004, 5, 6, 7, then 2008, 9, 10, 11, 12 would have been a whole different experience for most of them. These two things are, number one, know your cash flow. And I'm not going to say make sure your cash flow positive. I'm going to say know your cash flow. Because if you've got strong income, I've got a couple of self-employed individuals I know that are making basically close to $1 million a year. If they're making $1 million a year, their income is crazy strong, right? Like they don't really know what to do with all their money. And they're trying to be smart with it. They're trying to spend it on things that are going to create better income for them in the future. But there's no end in sight currently. Everything looks really strong and stable for them. And they're like, what do we do? And so if that's you and you're not going to miss $500 a month, then if you go and you purchase a rental property $500 a month, it's fine, right? At least for now. Now you need to be smart. You need to look at your job and think, hey, is there a risk of the income going down? And if there is, then have a plan in place for that. For example, if you are going to lose $500 a month, it's only a matter of time for how long you're going to lose 500 because rents will keep going up as the years go by, right? Monthly payments will go up a little bit with tax and insurance, but rents usually go up faster. So maybe it takes 5 years. If it takes 5 years until you hit that spot where you're actually going to be making money, that $500 turns into $400 loss, turns into a $300 loss, and that turns in, eventually you're going to start making money. Let's say it's 5 years. Well, if it's $500 a month, that's a lot. $500 a month, that's $6,000 a year, right? And then 6 times 5, that'd be $30,000. So if you went and bought this rental thinking, hey, I got to make sure I'm stable all the way through the end. What if I put my money down, I buy the property, and then I take another $30,000 and I put that $30,000 aside as part of that bank account when I open up the bank account for that rental, and I just leave that $30,000 sitting there and I can peel it out. Well, now this rental is fully self-sufficient for me, and it's no longer a concern to me about one day weighing in on my capacity, my personal finances and stuff. It's fully self-sufficient because by the time it hits year 5, it's going to be making money and it no longer needs any money from me, right? So know your cash flow. That's principle number 1. Make sure whatever the cash flow is, it folds into you and your finances and you're not exposing your family. That's 1. 2, what's the next biggest thing? I think it is reserves. Again, going back to the 5 agencies, Fannie, Freddie, FHA, VA. So Fannie and Freddie have a rule where they typically will want as much as 6 months of your monthly payments and savings. If you have 6 months of your monthly payments and savings, that's usually the most they'll ever require. So if you have 6 months in savings, that means you can make 6 monthly payments with no rental income coming in at all. That's a pretty stable place to be. You're still going to have, some costs that'll come up, like new roofs once in a while, new siding once in a while, smaller ones, but still significant, like maybe new hot water heaters, things like that, which you can defray some of those with like a home warranty or whatever. But is if you have 6 months reserves and you know your cash flow and you've planned accordingly, I really don't think you're going to be able to buy a rental property that turns out badly. I think you're going to be in a really good spot. And so those two principles, having reserves and and knowing your cash flow, I think is really what it boils down to. It's really the most valuable thing that people can focus on when they're buying rental properties. Other than that, gosh, there's all kinds of other advice. Since I've kind of started, I guess I'll continue on that. So I think the biggest advice I ever got, or I don't know if I fell into it or somebody told me, I don't remember anymore, but I really liked this, where I know a bunch of other landlords. When I first started, I think it was 2017, I didn't know anything, right? In fact, when I bought it, my attitude was, I'm not going to make anything. I don't care if I make anything. This is all about going to school. I'm learning. And so when I did that, I went ahead and started talking to my friends who also owned rentals. And so my advice today is, if you do this, I recommend that you have 3 or more friends people that you know and trust that you can reach out to. One really, really cool thing I've observed in my career is that landlords generally love to share. It's like the least competitive business I've ever come across, honestly. So any landlord friends that you have, if you tell them that you bought a rental and you're asking for some advice, you're probably going to get more than you bargained for. I remember one day, my wife and I were buying a new stove, or I think it was a stove. And I don't remember all the scenario, but I remember we basically got it off of KSL, which is like a Craigslist for anybody watching this outside of Utah. And when we went and picked it up, we're picking it up from a landlord. So that landlord was getting rid of it because he was kind of remodeling and putting a newer one in there or something like that. And so anyway, he found out, and I want to say he had like 20 buildings himself or something like that. Way more advanced in his experience than I was. And he sat there for the next 20 minutes. I don't remember really asking him any tips, but he was happy to give them to us. And it was really funny, but that is just super typical. And so that's probably one of my top pieces of advice, besides the 2 I already pointed to, the 2 principles, is I would say, surround yourself with people who own more rentals than you, that you can ask questions and see what they do. I remember the first time somebody asked me if they could have a pet, and my knee-jerk reaction was no. But then I kind of got to thinking about it, and I was like, well, let me ask my friends. And I did, and I have several people that have pets, and there's a pet deposit, and there's a few other things, and I've got my own opinions of how to run that now. But at that time, I had zero experience, so I just reached out to them and kind of averaged everything that they said together and offered it to my tenants, and it was great. And so I would say, surround yourself with others. I don't actually know if I have a lot of other advice. Yeah, actually, we can talk about how you hold, but that's probably getting outside of my license. That's probably starting to get a little dangerous to my legal licensing. But I have chosen to own all of my rentals in individual LLCs. And then talking with my real estate attorney and CPA, which may cause you to ask the question, do you need one? Do you need a real estate CPA or a real estate attorney? Not necessarily, but I just happen to know one. So I reached out to them and also connected them with my CPA on a 3-way call one day, and was asking them questions. And they recommended to me that I have an individual LLC for each business. And then in those LLCs, I also open individual checking savings accounts, checking accounts for each one of the LLCs. so that they're all independently operating, and I could have a parent LLC that kind of manages, all of them together. But that it would be important that each one be their own independent entity, and having their own tax identification number and an LLC, and having their own checking account, doing all their own banking and their own, receiving the rents to their checking accounts, paying the mortgages from their checking accounts, all these being key components of that, was something that they recommended. So whether or not that's appropriate for you, you need to check with your, tax and real estate attorney as well. But for us, that's what we were recommended. I think that's probably about it. There might be some other things. Maybe I'll throw them in. We're about 20 minutes in. I think I would like to go ahead and jump into the history stuff. I don't know what you're doing while you listen to this, if you're working out or if you're driving down the road, but 20 minutes feels short for something like this. And so feel free to come back later if it's long. But I want to take you through, I think I'm going to start kind of where I let off, which isn't current. But I'm going to jump into, I think, around 2008. There's a couple of amazing stories that I like to share with people that I feel like blow people's minds, honestly. And so I'm going to start there with this housing crash. I'll circle around to the Federal Reserve and kind of who they are and what they are. And then I'll circle back to the pandemic. I won't circle. There's no circles. I'll be go to the pandemic and kind of what the Federal Reserve is to us today. So 2008, July of 2008 is probably the most exciting moment in my experience. I remember it was the end of July, and one of the companies I'd been working with, which cutely named, was ABC Mortgage. ABC Mortgage, we called them and emailed them, and I don't even know how I ever found out, because I don't think there was any response. But around that same time frame, we somehow found out that they had closed their doors and were not opening again, unbeknownst to their employees, unbeknownst to the $800 million of loans that had been closed but not funded the day before. And 800 million in our language today doesn't sound like as many homes as it did in 2008. But that is a lot of home buyers. And it's all across the country. People who had purchased homes, closed on them, signed the papers, but the money had not been sent to title yet. And that was expected to be the next day, and it wasn't. And then the next day, and it wasn't. And then they all found out that this company wasn't opening again. There was no money coming. This company had gone bankrupt, gone upside down. They didn't even go bankrupt. They just closed. I don't know what the rest of their story is. But that was a huge eye opener, because that was one of the biggest companies in the country. That was huge. Shortly thereafter, Washington Mutual goes out of business, and Lehman Brothers goes out of business. Now, to put some of this in perspective, up to this moment, Enron was, I think, the biggest bankruptcy in U.S. history, and I want to say it was $9 billion, or maybe it was $6 billion. You can Google search that or chat it or whatever. But what I found out was that the Lehman Brothers bankruptcy was $600 billion. And so talk about dwarfing the previous biggest bankruptcy in history. 100 times bigger bankruptcy. That was Lehman Brothers Bank. Same time, Washington Mutual goes out of business. Now, this story is incredible. If you don't recognize the name Washington Mutual, they were every bit as big as Chase Bank, every bit as big as Wells Fargo. They were one of the national behemoths. Just a massive company. Probably a lot of politics involved in this, but they went out of business for an interesting reason. They actually had $323 billion in cash deposits the day they went out of business. So fathom that for a second. Just pause and think. They had $1/3 of $1 trillion in actual cash the day they went out of business. So that's a mind blower. When you let that sink in, then you got to ask why. How the crap did they go out of business? Now, at that era, there was a rule. The Federal Accounting and Standards Board, FASB, had a rule. I think it was Rule 157 that regulated banks. And a bank, and I think it had more to do with their stock prices than other things. Um, but they had to revalue their business every single day. And part of their valuation was their stock price. They could have a certain amount of cash capital versus how much loans that they had out. But if the cash capital dwindled too much, then they would have to sell loans. And their cash capital included their stock price. Well, if you don't know, in 2008, stock prices fell through the floor. Somebody who had $100 stock value fell to $5 of stock value, or $5 per share. Some of them fell even farther than that. Um, so what happened is they had, you know, X number of dollars in cash deposits or cash reserves that was their stock price, and that because the stock price fell so much, then their cash fell that much. So they didn't actually lose any cash; they lost equity in their stocks, and because they lost equity in their stocks, then the cash to lending ratio fell out of whack. And when that happened, why that matters to us is because the FASB rule basically requires that they have a ratio of maybe 10 to 1, 15 to 1 tops of loans versus dollars actually deposited. And they had gone up over 30. I think it was like 32 to 1 at this moment. And because they were 32 to 1, then the Federal Reserve steps in and closes them and ironically sells them to Chase Bank for, I think, $9 billion. And so, like I said, I'm pretty confident there was some heavy politics behind all that. But I mean, Chase Bank made out like a bandit. They had $321 billion in cash deposits. For $9 billion they had to pay. I don't know how many loans Washington Mutual, 90. So 90, all the mortgages that Washington Mutual had, which is part of the whole crisis that they experienced, 91% of their mortgages were paid on time. Explain this one to me. 91% were still paying on time. So then Chase Bank ends up with $9 billion to purchase this giant behemoth of an asset. So wonderful experience for Chase, I'm sure. But the reason that mattered is because when Washington Mutual went out of business, all of the banks started doing business an entirely different way because everybody else knew Washington Mutual. That's like, wait, what? They're too big to fail. How the crap did they fail? And so when they went out, all of a sudden, all the banks started underwriting loans a second way. And this is the first time in my career that I remember seeing it. But the first way was the way that we all expect. Can this person afford to pay this loan? And that's what we call the ability to repay, which is in federal guidelines, by the way. But on top of that, they now started underwriting the loans to whether or not they could sell that loan. So the one mistake that Washington Mutual had is they had a bunch of niche or portfolio loans. They were a big lender of their own loan products that nobody else purchased from them. And they had a really large portion of their loans. And so nobody else would buy those loans because they didn't know what to expect from them. It wasn't part of a big pool of money that could be liquidated easily. And so they couldn't sell off. And so their ratio of how many assets they had to the loans just continued to skyrocket, and they couldn't sell off any of those. And so that's part of the story behind that. And that's why today, when we apply for a loan, we're not just applying to see whether or not we can repay, and the banks will do that judgment. They're also deciding whether or not they can sell your loan, if it fits in the box or not. And if it does not fit, it doesn't matter if you can pay or not. They ain't giving you the loan. So, okay, let's fast forward. So a whole bunch of other banks, I think it's like 1,500 banks go out of business. Washington Mutual was the biggest ever, still to this day. However, if you remember Silicon Valley Bank that went out of business, was it 22 or 23? I think it was 23 when they went out of business. That was the second biggest failure since WAMU. So they were actually a massive bank to be going out of business like that. And the powers that be definitely put a lot of downplay on that in the media because it could have caused a massive frenzy. And as it was a pretty significant frenzy. But that Silicon Valley Bank was a different style of bank. It was more of an investment bank than it was like a Wells Fargo or a Washington Mutual was or whatever. But all the same, it was massive. It was a really, really big bank to be going out of business. And so big assets and stuff when they did. Anyway, so going back to 2008, 9, 10, 11, so all these banks are going out of business. It was really hard to be in the business at that time because I felt like throwing mud up on a wall. I never knew if somebody was going to be able to get a loan because I didn't know if the lender was going to stick around long enough. But in the end of 2008, the Federal Reserve made an announcement. Now, the Federal Reserve is not the U.S. government. Federal Reserve is an independent entity. They work closely with the U.S. government, but technically, they are not controlled by the U.S. government. They work cooperatively, but they print our money. They are our money supplies. So they are in charge of all the banks who use Federal Reserve notes, which is pretty much everybody at this stage. You're going back a few decades and especially over a century, and you're going to find that the American dollar, the U.S. dollar, is had a lot more diversity. There wasn't just a U.S. dollar. There were basically dollars from all the different banks and credit unions in the country. Nowadays, we've pretty much unanimously adopted just the Federal Reserve note. The U.S. dollar is that, and it's not controlled necessarily by the U.S. government. So go figure. Not going to get into any of that, but what the Federal Reserve did in 2008 in December is they made an announcement that they were going to print $600 billion and purchase with that $600 billion treasuries and mortgage-backed securities. Now, when they made that announcement, that told the markets that were investing in bonds, that told them that there's a big buyer coming into the marketplace that's going to purchase a lot of mortgage-backed securities and treasuries, which immediately sent the prices to both those items up. And when you send the prices to those two items up, you send the interest rates to those two items down. So immediately the 10-year treasury and most of the treasury notes and bills in general, the rates started going down on them. And immediately the mortgage rates started going down. That's 2009 is when that really enacted. That was also known as quantitative easing 1, QE 1. And then when it was depleted, before it was depleted, they expanded it to $1 trillion from 600 billion to $1 trillion. So the Federal Reserve printed $1 trillion. And then when that was completed, then they announced QE 2, quantitative easing 2, where they printed a second $1 trillion and did the exact same thing with it. That is a huge part of what kept our banking market together. If you go back to that era in 2009, 10, 11, and 12, our markets were a mess. The whole world was a mess. Just a mess. It was crazy times. If you are not real familiar with that time, you should look into it because it's kind of mind-blowing that we survived it, frankly. They call it the Great Recession because it had similar impact, though still quite a bit smaller, but similar impact to the Depression. It was not a little deal. It was nearly, and it really was in many ways, a world catastrophe. The banking world had gotten very, very entangled all across the globe, and so countries all across the globe were deeply impacted by this. Jobs all across the globe were lost and stuff. So anyway, quantitative easing 1 and 2 really carried the whole world for kind of through it. And then they announced when QE2 was done, I think this is 2013, they announced QE3. QE3 they dubbed QE Infinity because rather than put $1 trillion limit, they said they would buy whatever they needed to buy to continue to shore up the markets. And so they continued through 2017. Now, 2017, they reached a point where they were like, we think the markets are doing pretty good. They've recovered pretty good. Now, mind you, interest rates were still in the 3s and 4s for most of that. They weren't in the 3s for very long. That was pretty much a 2012-13 thing only, and that was the lowest they'd ever been in the history of our country up to that point. I remember offering 3.25, a 30-year fixed rate to people in 2012, so pretty great rates. And this is the problem, actually. This is part of why I'm giving you this huge history lesson, is that's part of the problem is because the era started all the way back in 2009 and 10, where interest rates went this low into the 5s, then into the 4s, and even into the 3s. And then they've been on and off in the 4s and 5s, and really not 3s, except for back in the pandemic. For almost 15 years, rates were that low. That's why people find themselves today where they're struggling to embrace these new rates of, they think that a 5.75 and a 5.875 is a high rate, and it's not. It's actually probably due to be higher than that, but the Federal Reserve is still deeply ingrained in the market right now, as I'll get to. So anyway, 2017, they look at the market and they're thinking the market's recovered pretty nicely. And so they make announcements that they're going to stop So what happens is when you purchase, let's say you have, I think they had about $4 trillion of mortgages and treasuries. Well, those are investments that have a time scale on them. A 30-year fixed, for example, it reaches a point where it's matured, right? And at the end of that 30 years, the loan is then repaid, and the money that the Federal Reserve put into the market has been repaid to the Federal Reserve. Well, when they get repaid through refinancing, through selling, through whatever means, when they get that repayment, they were just turning that repayment back into new investments. And so they were reinvesting all of their proceeds. They weren't selling off their balance sheet, they were reinvesting it. Well, in 2017, they made the announcement that they were going to go ahead and actually start minimizing those reinvestments and even start pulling them back a little bit. And so by 2018, I think they got to where they were not reinvesting anything at all. And that's where rates kind of went back into the fives. And then in 2019, late 2019, there were recessionary indicators that came up, and for reasons I'm not aware of, the Federal Reserve made or started making new investments in the treasuries, not mortgages, just treasuries. And I don't know if it was connected to COVID-19. COVID-19 really hadn't become a thing yet. Not really sure, but whatever it was, they made that announcement. Or they didn't make that announcement. They just started making that investment. But of course, March 2020, COVID is definitely a thing at that stage. And at that point, the Federal Reserve comes back into quantitative easing, I guess they didn't call it that. But they started making massive investments, way bigger than they probably needed to. And so over the next, I think it was 22 months, they printed $5 trillion more and purchased with those $5 trillion mortgages and treasuries. And that's what brought our treasury rate all the way down to the ones. And it brought our mortgage interest rates all the way down into the twos. I had several clients get into the ones by paying some points to get into the 1.75, 1.9 rate range for their 30-year fixed mortgages. And so that's where everybody, of course, solidified in these 3s and 2 rates and got super attached to them. And now, so that's the pandemic kind of ends, 2021, we'll call it. 2022 is where people kind of stop talking about it as much. Well, 2022, the Federal Reserve starts selling. So they start not only letting the reinvestments, they stop the reinvestments as they're getting paid off. They actually start selling mortgages or selling their holdings in the mortgages and treasuries. And so to this day, we're sitting at right around 6 trillion. I think it was 6.3 trillion last time I checked. So they printed a total of 9 trillion, and then they've let almost 3 trillion of it slide off the balance sheet. And that's kind of where the Federal Reserve sits at the present time. And so I'm really excited the Federal Reserve did what they did in 2008, 9, and 10 and all that, because that really, really helped the market. I'm not as convinced on what they did in pandemic. Nobody's asking my opinion, so it doesn't really matter. But the reality is because they stimulated so heavily on an already stimulated market, when they did that, that's what led to all this inflation. A lot of people were gaining a lot of money in the 2016, 17, 18 era, which is why the Federal Reserve was pulling back to begin with. But when they came in with such a vengeance in the pandemic that they put so much money into the marketplace that when you print money and buy stuff with it that puts money in circulation, when it puts it in circulation, it's getting around to other people. And so people suddenly have, who you normally don't have $1,000 in savings, they suddenly have $10,000 in savings. And they're like, ooh, I'm rich. And because they're not used to having $10,000 in savings, what do? They go and they spend the $10,000 buying things, and they still have their $1,000 in savings they're used to. But then the other $9,000 was used to spend money, go on vacations and buy toys. And that's what the American consumer was supposed to do. But by doing it so strongly, because the Federal Reserve overcooked it, that's where all this inflation came from that we all saw in, what was it, 2023? Or was it 2000? Yeah, I think it was 23. 22 or 23 in October, we hit a 9.9% inflation rate, or 9.5. I can't remember now. But anyway, so that's the highest inflation we've had registered in like 40 years. And that's where it all comes from. So there you go. There's a little bit of a lesson of who the Federal Reserve is and the roles that they've played in the mortgage world and the roles of the Great Recession in the mortgage world. It is really interesting to note, since I'm into history, one last note, and this is kind of not really here nor there for anybody. But if you remember in March of 2020, when the pandemic hit, you'll remember quickly thereafter, I think it President Trump was in office, and he said that you don't have to make your mortgage payments. And when that happened, so here's the way the cycle works. There's a cycle. Like, you have your 401k, you've invested it over here. The 401k is invested it in stocks and bonds. Some of the bonds are mortgages, right? And those mortgages go to Fannie Mae and Freddie Mac, and then you go to Fannie Mae and Freddie Mac to get a loan for your house. And so you're over here investing money in the very people that are giving you the money for your house. Well, when the president comes in and says, hey, monthly payments don't have to be made anymore to Fannie Mae, Freddie Mac, FHA, and all them, well, that's like cutting into a circle that needs its whole circle in order to survive. And so when you cut this, it suddenly cuts life to the entire circle. And so it caused a massive panic in the markets there for a minute. So quickly, Fannie Mae and Freddie Mac came out and said, oh, you don't have to make payments to us anymore either, because the FHFA got that figured out. To be honest, I'm still not quite sure if I ever quite figured out how all that worked, because who was making payments to your 401k and stuff? I don't know. But in any case, they basically allowed people to modify their mortgages, not just stop making payments. Everybody else had to get caught up. I counseled all of my clients to make sure you keep your monthly payments. Don't spend them if you've got them. And then sure enough, we were able to apply, and then they do modifications. And so they just move the money to the back of the mortgage or something like that. And that kind of kept everybody going. But fun moments that politics get involved in the free markets and how it messes up with the free markets. But I think that's enough for today. Got you 41 minutes. Hopefully that's enough for a good workout at the gym. And hopefully you had a good workout and you weren't loafing too much or got too distracted, or hopefully I didn't put you to sleep. Information like this can't always be the most exciting. So, and any of those that have not been enjoying my flag in the back, I do apologize. I love the Utes as well. I do root for them regularly, but not when they're playing the Cougars. It's just nice to finally have a solid year from the Cougars, where there's no denying that they've been a great and strong team this year. But honestly, so have the Utes. It's been a really great season watching them crush a lot of their opponents. And I don't think anybody else is going to care that I have a BYU flag hanging up in the back. So I think it's just my neighbors that are Ute fans. So anyway, I hope you're doing great. I hope this message found you well and it was a great blessing. I would love feedback. I would love interaction. So if you've got something you want to throw in the chat, you got a question or you've got a comment, please weigh in on it. Anybody you know that might enjoy this, please share it with them. And then, feel free to subscribe as well if you found it valuable. In the meantime, you have a great week. We'll catch you later.